Ty Young is the CEO of Ty J. Young Wealth Management, one of the leading retirement and advisors in the United States. And great to have you here in person. We've talked on Zoom several times, so great to have you here. So tell us about your business and how you serve clients.
Sure. So I'm the founder of the firm. We're a wealth management firm. But way back when, I was a cold caller at Bear Stearns. My wife actually got me a job as a cold caller at Bear Stearns. And I learned how to cold call and to pitch and to sell stocks and bonds. And sometimes those investments went up, and that was great. But sometimes those investments went down. And for me, it was heartbreaking to call clients and say, "Hey, you lost money."
Yeah.
I thought about, there had to be a better way to serve our clients. And that's where our style of wealth management was born. Our style of wealth management is growth of your money, stock market growth, but protection against market losses at the same time.
Okay.
Our clients they're not the Microsoft founder. They're not Elon Musk. So if the stock market goes down big and the market crashes from time to time, market goes down big, those guys, they can stay the course. It's no big deal to them. But for our clients, they have 500,000, a million, $2 million, or 401k roller. That's their nest egg, right? The market goes down big next morning. They can't wait it out. They have to pay their bills, right? So the way we serve them is our style of wealth management. They are protected against losses, but when the market goes up, they go up with it, and their gains lock in on an annual basis. So that's our style. And as we start out, and I actually started the business with my wife and I in the garage in a little town called Woodstock, Georgia. And we told everybody who would listen. We told, we asked for referrals. We did seminars. We did radio shows. We did TV. Now we still do national TV advertising. And in the last 7 years, we've acquired about 40 companies. And now we serve 7,000 clients and billions of dollars with our style of wealth management. And our clients don't lose money when the market goes down, and they go up when the market goes up, and their gains lock in. It's fantastic. I
Yeah.
love what I do.
What an amazing story how you built that up and you started really on the ground floor. Now you implement a lot of annuities as part of your strategy, right? So explain an annuity. I think everybody's heard of it, but nobody knows exactly what it is. And explain what it is and why that seems to be well positioned for what you're doing.
We achieve our style of wealth management through using a specific type of annuity, right? It's called a fixed index annuity. There's all different kinds of annuities, right? Um, some I like, some I don't like, right? There's good annuities, bad annuities, just like there's good stocks and there's bad stocks, right? So the type of annuity that we use is called a fixed index annuity. Fixed, meaning your principal's fixed, you never lose anything. Index, meaning you go up with the market index like the S&P 500. And the gains lock you in on an annual basis, right? When the market goes down, you don't lose anything. So we use those annuities to achieve growth and safety for our clients. And I kind of want to make sure that I say this out loud. We can't just buy one of these. There's hundreds or thousands of different types of fixed index annuities, different products from different companies, and different ways you can set up. And our guys, our advisors at Ty J. Young Wealth Management, they are ninjas setting these up where you get the right product, get it set up properly for maximum growth, and then you have to manage them on an ongoing basis, making sure that you're set up with the right index, so you're set up with the right crediting method to maximize the returns, to maximize liquidity, and to maximize growth, and to make and continue to have safety. So, things change as retirement goes on, right?
Yeah.
You want to go see your grandchildren, you got to pay your monthly bills. All those things work into it. But if you have safety as the guideline, and you make sure you just never lose money, it provides security, and our clients sleep at night.
Yeah.
Great thing to do.
So you've got the protection on the downside. Is there income from these two?
Sure, sure. If you want it, you have some choices. Some people have a pension, some people don't. Some people need income out of their retirement. Some people don't. So if you want to take income, you can take, there's plenty of liquidity. So you can take out monthly income if you want to. Others, they may not touch it at all. And this is money for the next generation. Okay. When it said, but the key phrase, or the factor that everybody wants is that safety. They want to go up and never go down. Their biggest goal is to never lose money when the market is down. They want to maximize growth, but they just don't want to lose money. And that's the need that we serve.
Sure, understandable. I mean, if you're in retirement, it's like you don't want to lose half your money because of some
Exactly.
whatever, crazy thing that happens.
It does happen.
Yeah, no, for sure. So have these been growing quite a bit, and how's the growth of the annuity business?
The growth of the business itself is tremendous. Right now, there's billions and billions of dollars for the whole industry going into annuities on a monthly basis. I mean, it's extraordinary. Our business has, I mean, we're having record year after record year after record year because people, what we do. I mean, it's not hard to tell a client, hey, but we help you have your money safe. We help you have it grow. You can take it out when you need it. And listen to this. If they're set up right, there's no annual fees. So, I mean, most money managers charge, 1 or 2% per year. Over a 10-year period of time, that's 10 or 20% of your money.
Yeah.
And most money managers don't beat the S&P 500. These annuities are tied to the S&P 500 with a cap now, but they're tied to the S&P. So you get the return of the index up to the cap. So you get the return, but without the fees because you're making a time commitment when you buy an annuity.
Okay.
It's 5 years, maybe it's 8, maybe it's 10. You choose the number of years that you want. But again, set up properly with the, with the right advisor, getting it set up and making the adjustments. It worked very, very well. Our clients love it.
So that's really where you come in is somebody's like, I want this and I want an income and they can help kind of tailor that to what this person's looking for.
Exactly. You can buy an annuity in any bank or from any, but it's the expertise of the advisors. Well, we do training every single week where we have a broad look at all the annuities that are available, the best way to grow the money, to maximize return. All fixed index annuities, your money's protected against losses. But many of them have fees. Well, you can't have fees. I mean, if you have a drag of 10, 20, or 1 or 2% per year, that's a meaning.
Adds up.
Yeah, it does. So avoid the fees, maximize return, and get the safe fees. It's so important to have them set up properly with an expert to get the maximum growth and to achieve your retirement goals.
Is there a minimum investment?
The best accounts are available at about $100,000. Minimum profit on this $500,000.
Okay. How can somebody know if this is a right product for them?
Well, you have to ask yourself a question. How much of my money, how much of my retirement money do I want safe? Average person that comes to us says about 60%. Then we ask a follow-up question. Here it is. How much of your money are you willing to lose? That's a very different question because what they say is none, right? That means that somewhere between 60% and 100% of their money needs to be completely protected against losses, right? There's only 3 ways to have your money completely protected against losses: FDIC insurance, treasury bonds, and guaranteed insurance contracts.
Mattress. There's always a mattress.
There, yeah. Unless the bad guys come, hope they don't, right? So, but generally speaking, is the fixed index annuity, which is a type of guaranteed insurance contract, and people like that over FDIC insurance and treasuries because the yield, the return.
You're getting some more, right? A savings account is like nothing. So, and that's interesting. You mentioned people might put 60% in annuity, but then if they want some kind of outgrowth, take advantage of, whatever, they can still put some in there too.
Absolutely,
Yeah.
absolutely. You just got to kind of figure out what's your threshold to sleep at night. I mean, when you retire, you don't have that monthly income generally.
Absolutely.
Work anymore.
No, I'm starting to think about that. So I get it. Yeah.
It's a big deal, right? So if you're within 5 or 10 years of retirement, it's time to think about, how do I protect myself? Well, everybody wants growth, and I think everybody should have growth. Most people need protection, and most people wanting retirement don't have it and don't have enough of it.
Yeah.
That's a big deal.
Okay. And where can somebody go to find out more information about your firm?
Our firm, you can go to tyjyoung.com, tyjyoung.com, and you can get a video investor's guide.
Okay.
And the video investor's guide, you open it up, there's a video there. It's like an iPad, right? And there I am right there on the screen explaining how you can have your money saved. You can go up with the market, lock in your gains when the market goes down. You don't lose anything. Forward with your money, never backward, up and never down, and no annual rates.
Yeah. What age would you say people is a good age to get into an annuity?
I would say starting at 50 or 55.
Okay.
However, if you're 35 years old and you say, I want all my money saved,
yeah,
it's a good place to go.
Okay.
Right?
So good.
Generally, that's 50, 55 is good time to start.
Got it. Okay. Ty, thank you so much for explaining this.
Yeah, my pleasure. Thanks for having me.